Alright, so today we are going to, I guess we can say, dive into or just review HHIS. So this is Harvest Diversified High Income Shares ETF. The reason why I want to talk about this specific ETF today is, first of all, maybe I want to start a new series on my channel where I start reviewing some very interesting covered call ETFs or income ETFs on the market. And second of all, I know that this one has been gaining a lot of traction just in my personal circle. I have some people around me that started talking to me about this one. And I thought that it wasn't as popular because it came out in January, and I just hear random people, like some friends at the gym, who told me that they bought HHIS, and I thought it was pretty funny. And I was very excited for them because I've been watching this one. It came out in January of 2025. And it grew a lot since it came out, and it's becoming very, very popular. So I wanted to kind of review this and give my opinion on it. Obviously, you know that this is not financial advice. This is just me giving my personal opinion and kind of giving my word on this and kind of going through Harvest's page and whatever information they have here. I'm kind of giving it back to you guys and trying to provide value on this ETF for hopefully if you're new to it or if you already know about this and you're just not sure. This video will help you learn about it. Let's get into this. Before I start, I just wanted to say that, first of all, thank you to everyone who've been subscribing and participating to my channel's growth and really supporting me in a very positive way. Also, feel free to subscribe to my channel. So I'm a Canadian investor and I cover all of these high yield US and Canadian ETFs. So if you want to learn more, then feel free to subscribe. Trying to grow my channel as much as possible and share this passion and yap about some finance stuff. So, alright, let's get into it. Harvest Diversified High Income Shares ETF. So obviously this is another high income ETF, but this one is very cool. Just to give TLDR about this one, it's kind of a Canadian all-in-one YieldMax type of ETF. So it holds a bunch of single tickers income generating ETFs, and this just regroups all of them. If we look at the overview, the Harvest HHIS ETF offers a multi-sector portfolio to capture a diverse selection of trending companies that are positioned for strong growth. So now let's look at their holdings. So I was saying that I've been following this one since it came out. It came out in, I think, January 16 of 2025. So it's barely 7 months old right now, almost. And when it came out, I wasn't very interested, but I kept my eye open for it because when it came out, they only had 8 holdings. So I thought that this was a Canadian YMAG because YMAG only has 7 holdings. So I thought it was interesting, but I'm not interested into holding an ETF of 8 holdings. That's why I like YMAX a lot because it's very diversified and they hold a lot of things and they keep adding. But now, if you go and you check at all of Harvest's ETFs, they keep adding and adding new single stock ETFs where they trade options on top of them. Every time they have a new ETF coming out, after 1 payout or 2 payouts, they add it to HHIS. So this is why I'm saying HHIS is kind of a Canadian YMAX, what it seems like. As long as Harvest keeps creating those high quality, high income single stock ETFs, they're going to keep adding them to HHIS. And HHIS is going to keep growing and becoming more and more stable and diversified. What I like about it is, as you can see, they have big names. Like they have Apple, Coinbase, Broadcom, Nvidia, Palantir, Netflix, Microsoft, MSTR, Meta, AMD, Amazon, Tesla, Alphabet, and I don't know if I said Costco, but we're done going around the circle. But I like that they have a mix of big blue chip like Costco and Apple that are a bit more stable, but they also have those more like techie, quote-unquote techie, volatile ones where they can probably use to generate more income, like Palantir, Tesla, and Nvidia, as well as AMD. AMD is kind of an underdog, and now it's been blowing up. But since inception, since January, they had AMD, so that's pretty cool. That's something that caught my eye. So let's review the fund. So they seek to provide high monthly income and growth potential from a portfolio of Harvest single stock ETFs. So like I was saying, they have all of these single stock ETFs and they just add everything into HHIS. So it's kind of your one-stop shop for income. And they use a covered call strategy on top of these single stocks. As of March 31st, 2025, they added leverage actually to create an overall exposure of 25% and a high monthly cash distribution to its shareholders. So what are the advantages of this one? Diversified exposure to top trending companies, as we can see here. You have exposure to the stocks and you have higher monthly income. So this one pays 25 cents per share and the NAV is $12.78. So I have an Excel sheet right here that I'm going to go through after, but essentially the yield that they're aiming for since inception is around 24 to 25%. And the thing about Harvest is that they're very conservative. So they trade options and I don't think they're too aggressive, and they try to aim for at least 25%. And this is how they're able to pay 25 cents a month, and they don't need to decrease or increase their distributions. And they probably pay out 25 cents a month and keep a healthy cushion. So when we saw the crash in April, let me just go straight to it. Here in April, that's where we had the crash. It still paid the same amount and the yield here was in the 30%. So it's a good ETF to hold for people who are maybe retired or who need the income, because they're very consistent. And even for investors in the long run, like when the market drops and the share price tanks for the ETF, they pay the same amount. So it allows you to average down your share price and to grab some shares at a higher yield on cost. So that's very interesting. I mean, that's the overall gist of HHIS. So basically, to give a summary, it's kind of like an all-in-one Canadian income ETF, and it's a very like community favorite right now, and it's growing and growing. Currently, they're at 580 million assets under management. Since inception, they had how many distributions? 1, 2, 3. They had 5 distributions, and they paid out $1.25 in total. So, just to give an example, like for example, Nvidia, if you want to look at exactly how they trade those single stocks. So even for the single stocks, they're very stable. So this is also how they're able to keep a 25 cents per share distribution on HHIS. Just as an example, as you can see, those single stocks themselves are leveraged. Yeah, so if we look at kind of their product sheet that they have on their page, this is just kind of explains to you how they work. And this is just for every single ticker inside of HHIS is how it's working. And maybe here we can see the kind of the difference with, for example, the weekly payers from Roundhill, or like YieldMax, or those single stock tickers from YieldMax. Harvest has their own strategies for generating income, and it comes with pros and with cons. So just to get into it, so here they have a covered call strategy. They're basically writing calls on maximum 50% of their positions. And I'll show you guys the price of the actual shares of HHIS itself. As we know, covered calls, I can make a video on that, or you can watch videos, like it's pretty simple. But covered calls, basically they limit the upside. So you exchange upside for income, and that's how they're able to pay you guys a high yield of 24% a month, for example, if you buy those shares. The thing with covered calls is if you're writing covered calls on 100% of the holdings, the whole portfolio is going to be capped on the upside. But since they're writing covered calls on 50%, then they're capping the upside on only 50% of the holding. If, for example, like most of their holdings goes on a bullish rally, or the stock market is going up, like just as it's going right now in mid-July, you're going to be able to catch some appreciation and participate to the bull market, even though you're holding technically an income ETF that is not made for necessarily growth as the first purpose. With HHIS, you would be able to capture that growth as well as that stable monthly income. Then for Canadian investors, it is tax efficient. So if you're holding this in a taxable account, I'm sure that they probably pay most of their distributions as capital gains. So in Canada, capital gains, you get taxed on only 50% of the amount, and it's not the same tax bracket as your like 9 to 5 income. And then high monthly income, obviously 24% yield, and it's a consistent yield, is very good. And modest leverage of 25%, on top of offsetting the capped upside of the covered calls by setting covered calls on only 50%. They're also leveraging the whole thing with 20 to 25% leverage. So that means that even if the upside is a bit capped compared to actually holding the underlyings, the fact that it is 25% leverage, you know, like it's going to push it up a little bit higher, and it's going to kind of offset and kind of mimic the volatility of the underlyings, even though it's capped by those covered calls. So you can have income, and you can potentially have almost the same growth as the underlyings. So it is very cool. And that was basically all I was saying before. Highly monthly income, and they write up to 50%. What else? It is leverage. Income from covered calls can be treated, just exactly what I was saying, treated as capital gains. So it's taxed at a lower rate, and it's not in the same tax brackets as your like 9 to 5 or regular personal income. And the lower purchase price, obviously, like you're able to buy those 15 holdings under a single ticker, which is much easier than having to buy every single one of them. So as we can see here, you have the basket of stocks. They write calls on 50% of that, and on top they have a 20 to 25% leverage. So here is how they do it. So they write monthly options. So they have net income requirements. So I suppose that those net income requirements are probably like the collaterals. So they probably have some cash and the actual stocks. Then they write cover calls on top of these on maximum 50%. And on a daily basis, they monitor it. So they probably just monitor the calls and everything on a daily basis, and they do adjustments when needed. Yeah, so here, for example, they have an investment strategy section inside their prospectus document. And it's basically the same thing for every single ticker. So let's look at AMD, for example. So in order to get their objectives of basically generating that 24% yield, for example, monthly minimum, they invest 100% of their assets directly or indirectly on AMD, and then they will write covered calls on top of AMD. Then what else? The proportion of the covered call options written, if any, could vary depending on the market conditions and on their needs. So I assume that if they've generated enough income for the month, they're probably going to stop writing cover calls, or they're maybe going to use strike price that are very far to enable us to capture upside, and they might not need to generate extra income that month. I'm not too sure, but I guess that's something that they can do if they want, subject to a maximum of 50%. So it's maximum 50%, but if some months they don't need to write cover calls, they probably won't, and they'll allow us to get more upside. So this is cool. Essentially, that's how it works. Now let's look at the price. So like I was saying, like the fact that we have leverage and cover calls on only 50% of the holdings, the price has been doing so well recently. As you can see, it came out in January. So it's kind of a bad timing, but I think that it's also a good timing because it came out and it gave us a test right as it came out to see like how could it do in bad conditions. And as I showed before, the distributions have been stable. Let me go back to the distributions. So the distributions, 25 cents per month, regardless of the market conditions, very stable. And as you can see, when the market crashed, so since inception, when there was all the fuss happening with the trade war and all the uncertainty in the market in April, it went down 30%. So I'm sure some people were mad and were scared that it wasn't going to recover because it is a covered call ETF. But since they're only holding on 50%, they're only writing calls on 50%. If you would have bought at the peak bottom here, you would be up 46%. So 46% on an income ETF that is writing covered calls is very good. So you're up 40%, and on top of that, you have an annualized distribution of around 24% plus per month. So like total return has been crazy since inception, and especially if you're lucky enough to know about the stock and understand it and whatever, and you wanted to invest into it, and you bought it when it was rock bottom here, it was so good. Like if you're able to grab this at a low price, you can lock in a good yield on cost and just write it up. It is able to recover a downside because it has that maximum covered call exposure of 50%. So now, to finish the video, I just took out some numbers and see how much you would have made if you invested $10,000 at inception. So yeah, I was saying the inception was on January 1st of January 16 of 2025. Let me zoom in. Price was $12.35. Total distribution since inception. And so if you invested 10K at inception, $10,000 divided by the inception price, you would have bought 809 full shares. So that's an initial investment of $9,991.50. From there, as you can see, their first distribution was in March, and up until July, the latest distribution, like the distribution was the same. So it's very easy to predict how much income you're making every month. And that's why I think that it's a good way to boost potentially the yield of your portfolio, is because it is predictable and it doesn't vary month after month. So you know that if you buy a certain amount of share, you can expect a certain distribution from those shares. So it was paying 202.25 cents per month, and this is how the share price move at the open price of each distribution date. And so as you can see in total here, you received $1,011 of distributions. This was the yield every month. So like I said, when the market crashed, the yield went up to 34%. So that's crazy. And now that the market recovered, it went up to 24.5. At inception, they really aimed for 24% yield. and they've done a good job, especially since it's a super young fund, to really handle the bear market we had in April very well. They didn't do any dividend cut or stuff like that, so that is very nice to see for a new fund like this. The current value of your shares in July at the latest distribution would be $9,869.80. So for the price return, you would be down 121, but you would have received $1,011 of distributions, and that is without reinvesting. That is just if you get your distributions in cash and you leave them aside in your portfolio. And the value of your investment would be $10,881.05. So you would be up 8%, 8.5% annualized. I mean, no, not even annualized. 8% in the last 6-7 months. These are very, very good returns. I think that's it, guys, for HHIS review. I really just wanted to go through the fund because I know it's a very popular fund at the moment and a lot of people are looking into it, but they're probably not sure. So hopefully this video helped you understand better about it and maybe opened your eyes and maybe helped you made your mind on knowing if it's something that you would like to invest into, or maybe you're not interested for XY reason. That was it. Let me know in the comments what you guys think of this ETF. Is it something you would invest in, or maybe it is not something that suits your investing style? Personally, I am thinking of investing in it. I'm just trying to find the right moment. Like, I'm trying to prioritize some other positions in my portfolio at the moment, but I am eventually probably going to rebalance my portfolio and sell some lower yielding stuff or some less diversified holdings to put them into HHIS, since it's been doing so well since inception. And Harvest kind of proved that they're able to do a good job even in bad market conditions. Alright guys, until next time, take care.